Welcome back. This is our series on professional conduct. This is the first of a three-part series in which we'll be looking at the code of professional conduct that's applicable to accountants and auditors. If you are using your auditing standards for South African students, then you'll be looking at chapter 2 for the content of this video. So let's get straight into our agenda for today. Firstly, we want to have a look at what is the Code of Professional Conduct. Particularly, we want to understand why public interest is so important. We then want to go over the part 1 of the Professional Code of Conduct, and that part is the one that deals with fundamental principles. We want to try and understand the fundamental principles. We want to try and be able to explain them in a given scenario. We also then want to look at what are the threats to the fundamental principles. The threats as well as the fundamental principles go hand in hand. So you only identify the threats when you understand what the fundamental principle is. So that's why we look at them together. So there's 5 fundamental principles, there's also 5 threats. However, they are interchangeable. So it does not necessarily mean that principle 1 always goes with threat 1. Instead, they're interchangeable and they can swap around, and each threat can affect a different principle and vice versa. And then finally, at the end of today, we're just going to conceptualize and put together what a safeguard might look like. We're not going to go too in depth into safeguards in this video. That's going to be in the next video. But we just want to try and understand what exactly safeguards will look like. And so that's what we'll finish off with today. Okay, so when we're looking at the professional conduct of an accountant, we come across what is called the IFAC code. Now, the IFAC code is an international code that dictates how an accountant needs to behave, particularly looking at their conduct in a professional environment. What we find is that in South Africa, our codes that are created and enforced by both SAICA, which is the body for chartered accountants, as well as IRBA, which is the body for auditors, these codes are both consistent with the IFAC code. So basically, the South African codes of professional conduct are consistent with international codes, meaning that they are very similar, and in fact, they cover all the same principles. Underpinning the codes that we're going to look at are 2 broad ideas. The first is the idea of ethics. Now, what exactly is ethics? There are different definitions, but basically it is a group of rules or morals that dictate the way someone needs to act. For us, we want to look at how ethics applies to the professional realm, and so we look at professional conduct, and that means a group of rules or moral standards and values that dictates a way a professional acts in his professional capacity. So that's exactly what we're going to look at. We want to try and understand the principles that are being practiced by accountants and how they should be affecting the actions of those accountants. So it's very important that we do that. Just so that you have an understanding, when we look at the codes, we're going to particularly look at the SAICA code. But like I said before, the 2 codes, the IRBA code and the SAICA code, are consistent and very similar. So when we're learning the 1 code, we are in fact learning 2. So that's going to help us. And we're going to have a slight amendment in video 3 where we talk a little bit about the IRBA code a bit more, and we look more into the disciplinary rules that is found in the IRBA code. So with regard to the SAICA code, we find that the SAICA code is applicable to professional accountants, right? So it's tailored to scenarios that the accountant might find himself in. And similarly, the IRBA code is tailored to things that the registered auditor might find themselves in. So there's a slight difference, but for the most part, they are consistent. So if a practitioner is a registered auditor, they would have had to be a chartered accountant before they became a registered auditor. That means that they need to comply by the SAICA code because they are part of SAICA, and also they must comply by the IRBA code. An RA needs to comply by both codes. The question is, why do we need two codes. What is the purpose? Why are we asking for two codes? Well, the two bodies actually are independent of each other, meaning that they aren't closely connected. However, the people that are part of URBA have to be part of SICA, but SICA tailors their code to what an accountant will find. And that may not be applicable and may not help URBA, because URBA needs to particularly look at people that are in public practice, right? And you're going to see this idea of public practice coming out, and we'll explain it a little bit later, what public practice means. So people that are members of SICA may necessarily not be members of URBA. However, people that are members of URBA will have to be members of SICA. But because the SICA code is tailored towards the accountant profession or the accounting profession, it does not meet the needs of URBA and does not meet the needs of the auditing profession. Therefore, URBA had developed their own code. URBA has also added onto their code the rules on improper conduct, which we'll look at in video 3. So let's have a look at the structure of the code. When we look at part 1 of the code, it deals with general application. This is basically the framework of the code, meaning that if we are confronted with a situation that we may not have seen before, we need to come back to the basics of part 1, and that will help us to deal with different situations that may not be known or may not have been encountered by previous accountants. So this is why it's important that we get the basics right. So part 1 is very basic. It just has the fundamental principles and the threats, as well as one or two ideas on how to develop safeguards. But it's very, very simple in that it creates the building blocks for us to use in an unknown situation. As we go on to the next parts of the code, you'll find that they become more and more tailored toward a particular type of accountant. So as with ethics, we cannot list every single scenario that an accountant will find themselves in. It doesn't make sense to list every single thing, every single ethical battle that a accountant will find themselves in. So we give you the basics, which is the building blocks of developing safeguards and protecting yourself from an ethical standpoint. And so you are able to use that in different situations. But then what the code does is to also give you some specific guidelines on very specific situations that you may find yourself in, so that when you are in a new situation, you can look at the guidance in part 1, then look at the other parts and try and understand what is the basic spirit of that law, and then you can apply it to your own situation. So that's what part 1 is about. Part 1 has the framework, it has the general principles, it has the basic building blocks that you can use in a different situation. Part 2, we talk about a professional that is working for a company. So when we talk about accounting services, you have one of two choices. You can either be employed as an accountant and do the accounting services for the company that is your employer. This is what most financial managers would do. They will be employed by a given firm and they will perform the finance function of that firm. That's what a financial manager is. So that person is not in public practice. That person is what we call a professional accountant in business, because they're offering their professional services to the company that employs them. So they are working in business. Part 3 will obviously deal with a person that is working in public practice. Now again, part 2 deals with people that are offering their professional services to the company that they work for. That's part 2. Part 3 is where your company actually offers professional service. That is the product that your company sells. So you are working at a company that doesn't necessarily need you to provide financial services to them. Instead, you provide financial services to the customers of your company. You can think of this as an external auditor. An external auditor doesn't go and audit his own firm. So if you have an external auditor at KPMG or PwC, they don't go and audit their own firm. They go and audit other firms. They go and audit the customers' firms. So that is someone who is in public practice, where the actual professional service that they are selling, whether it be finance or tax or auditing or accounting, that service is what is being sold to the public. So that is someone that's considered to be in public practice. Part 3 deals with that kind of professional. When we're dealing with part 4 focuses in on a very important topic for accountants, and that is independence. Being independent of your company that you work for as well as your client or your customer that you work for. Independence is a very important part of what it means to be an accountant, because without credibility, the accounting profession falls flat on its face. So we have to have credibility, and credibility comes from independence. So we're going to look particularly at independence in part 4. And part 4 is just basically a list of different examples of how we can apply independence. And then finally, when we look at video 3, we are going to start to look in on IRBA's particular code. Now there's 17 different rules that IRBA has come up with that particularly look and focus in on the auditor and the behavior of the auditor, and we were going to look at that in video 3. So these are the 5 things that we're going to be looking at in this series of videos. Okay, so let's move on to the public interest. Now, you'll remember that we already discussed public interest in our introductory video, which you can find on my channel. And when we were discussing public interest then, we actually said that the chartered accountant heavily relies on his ability to gain the public's trust. So, because we work on behalf of the public in our efforts to audit as well as in our efforts to produce financial statements, we are actually doing this for the benefit of the public. As a result, our work is considered to be of public interest or in the interest of the public. For example, we offer accounting services such as preparing financial statements of listed companies. We also do audit, internal and external. We prepare tax returns for the revenue collector, but also on the other side, we work at the revenue collector to assess tax returns that are received. As a result, as accountants, we do work that adds value to the public. That's what public interest means. But why is public interest important to our professional conduct? Well, when we act as chartered accountants or as professional accountants, we want to ensure that we protect the interests and the values of the public in our work. Why? Because our work is extremely specialized. There is no one else that will be able to fulfill the roles and duties that we do. For example, if accountants were not trusted, who would do the accounting? As a result, we have to ensure that our conduct and the way we act as professional accountants continually enhances and maintains the current public interest and trust that we have gained from the public in general. Okay, so let's move on to part 1 of the Code of Professional Conduct. In part 1 of the Code of Professional Conduct, we are introduced to the framework of the code. Remember, this is the part of the code that gives us a basic framework that we can use to tackle any situation that may arise. This framework is a 3-step process. First, we need to identify different threats that may arise. And these threats will be threats to particular fundamental principles. These fundamental principles are basically the heart or the cornerstone of our profession. Once we identify these threats, we need to understand the significance of the threat. What does that mean? That means digging deeper to identify or evaluate how likely the threat is to come to fruition, and what the impact of such a threat will be if it were to come to fruition. Finally, we want to be able to address the threats. We address threats through the development of what is called safeguards. Safeguards are basically actions that the accountant can take to eliminate or reduce the threats that are present. We'll then also have a look at how these things affect the audit profession. Remember that we will do this in video 2. And then in the final video, we're going to look at independence of mind and appearance. So, the first of the fundamental principles that we'll be looking at is integrity. Integrity is very easy to explain. It's simply the accountant needs to be honest, straightforward, truthful, make sure that the information that they provide is fair and clearly reflects what are the material aspects of the business. However, this principle goes beyond that, in that it requires accountants not to associate themselves with false or misleading statements or financial information. This means that the chartered accountant must avoid statements that may be misleading, must avoid omitting or obscuring financial information that gives a different picture to what is really happening. They must disassociate themselves from any information that may be considered to be misleading. However, I want you to think about this. If we disassociate ourselves from information that's misleading, that means that we need to give users of information a full picture of what we are dealing with. This may mean revealing information that is confidential. So, this particular principle sometimes is found to be in conflict with the another principle of confidentiality. The next fundamental principle that we're going to look at is objectivity or independence. This basically means that the chartered accountant must act in a way that is free from bias. In other words, their professional judgment and professional skepticism must not be influenced by any person or anything. Principle 3 is about professional competence and due care. Now, this is one of the very overarching principles and is very critical for students to grasp. Because what this principle basically says is that a chartered accountant or professional accountant must maintain their professional knowledge and skill at a level that is required by clients or employers. This means that even though a chartered accountant may pass the board exam many years ago, they must remain up to date with new and changing regulations that may be applicable to their company or sector. They also need to act diligently to ensure that they apply their technical knowledge and professional standards when providing services to their employees or clients. In addition, when acting with due care, a chartered accountant must make sure that the service that they provide is competent. What does competent mean? It means that they need to act in a way that is timely. In other words, not missing deadlines. They need to also be careful about the work that they do to avoid mistakes and human error. They need to work through their work in a very methodical and thorough way. And finally, they need to make sure that the work that they perform is in line with the regulations, standards, and requirements of the profession. Now, let's take a step back and look at a student's viewpoint. Students need to be able to work in a timely manner, meaning that they don't miss deadlines. They need to be careful about the work they do so that they don't have any errors in the work. They need to also make sure that it is applicable to the standards that are required. And where do the standards come for a student? Well, it's the tests and exams. In addition, a chartered accountant must ensure that when they apply their professional judgment, it is done in a way that an independent third person will view their judgments as being up to date and technically sound with business developments and changes in the sector. So, when we often talk about the judgments of chartered accountants, we talk about the third party test. That means that a third party, given the same knowledge, skill, and ability as the accountant in question, will come to the same conclusion as this accountant. This is a very rigorous and a high level of testing for a chartered accountant. It's a high standard to ask them to apply. And so, a chartered accountant needs to be very careful when they exercise judgment. Another overarching requirement for a chartered accountant is that they not only apply this rule of professional competence and due care, but they also need to make sure that all the staff working under them, regardless of whether that staff member is part of the accounting profession or not, that staff member also needs to apply this. Now, this is a wide, broad requirement for the chartered accountant. So they need to make sure that not only are they working in a timely manner to meet deadlines, they need to work in a careful and thorough manner, they need to ensure that standards for the profession are applied, but they also need to make sure that their staff does the same. So I want you to think about, how would you, if you were in management or you were a supervisor, how would you make sure that your staff applied these principles? The fourth fundamental principle that we're going to look at is confidentiality. Now, confidentiality simply means to keep something secret or only allow those who have the authority to view something. This is one of the very important principles for a chartered accountant. Why? Because a chartered accountant often has information that the public does not have and that may cause issues if they use it for personal gain. This requires the chartered accountant to respect confidentiality of the information that they gain as a result of being a chartered accountant. So the principle is very particular that you must only treat information confidentially if it arises because you have gotten access to that information because you're a chartered accountant. It also says that we must not use such information for our own benefit. This may mean being careful in a social setting. When we discuss matters that we find at work, we must be very careful not to discuss confidential matters. We must maintain confidentiality within our firm and our organization, meaning that we don't discuss it with other workers even. We should not disclose confidential information as a result that we've gained as a result of being a professional outside of our entity without proper authority from our entity. A chartered accountant needs to also ensure that they take responsible steps to make sure that also their staff members don't disclose information to anyone that they're not supposed to. Now, the code does accept that sometimes a chartered accountant has to disclose certain information, and it also gives guidelines for how a chartered accountant should disclose that information. It says that information should only be disclosed under 3 very particular circumstances. The first is that if the law requires us to disclose the information. Number 2 is if the client who is involved or the party that's involved in the information gives authority for us to do that. And number 3, if it is a professional duty for us to disclose this information. So if there's some sort of illegality involved, we must disclose it because it's a professional duty. The code also reiterates what sort of disclosure needs to be made. The first is that we must make sure that affected parties are limited. For example, that may mean redacting or removing the names of affected parties that are not essential to the disclosure. We also need to provide anyone that we are disclosing this information to with proof that what we are saying is correct. And finally, we need to really consider the presentation of this disclosure to ensure that it achieves the goals that it set out to do. Let's look at the 5th fundamental principle, and that's professional behavior. For me, this principle is really the net that catches everything, because it is an overarching and very broad principle. So if something does not fall in the first 4 principles, it is highly likely that it will fall under this principle. Why? Because let's look at the definition. The principle simply says that a chartered accountant must act in a way that complies with law and must act in a way that does not bring disrespect to the profession or bring the profession into disrepute. Now, one can use those 2 requirements, particularly the second requirement, and mold it into almost anything. So this is a very large, overarching sort of principle. One can argue that a specific action brings the profession into disrepute, so the code gives us some particular examples in which this principle needs to be practiced. Let's have a look at them. First is publicity, advertising, and solicitation. The code tells us that when we engage in publicity, advertising, and solicitation, we should do so in good taste. It tells us that when we engage in publicity, all parties that are involved in the publicity need to be notified before we go public with it. This may mean getting comment from different people before we disclose certain information. With regard to advertising, we should always communicate our advertising in good taste, meaning that we don't bring another member of the same profession into disrepute or say that our services are better than another member. That is considered to be wrong. So solicitation, where you approach one or two clients individually and attempt to get their business. For example, this may be likened to a Avon salesperson, where you go door to door and try and make a sale individually. The code tells us that solicitation is not allowed for accountants. So accountants are not able to approach individual members of the public and attempt to get their business. The only way they can get business is either via referral or advertising and publicity. Being members of multiple firms can create problems. Although the code does not outlaw it, you must ensure that there are no conflicts of interest that arise when you are a member of more than one firm. When we particularly look at an auditor, IRBA says that auditors should not really be members of more than one firm, particularly if they are members of the audit firm as well as the audit client. That's not allowed. With regard to signing audit reports, the code is very clear. The responsibility to sign audit reports or any sort of reports cannot be delegated to anyone else. So you need to do it in your individual capacity. However, after some initial pushback, we've seen in recent years an amendment to the code that says in case of emergency, a professional accountant may allow someone to sign on their behalf. However, there must be written consent obtained from both IRBA and SICA if this is to be done. Obviously, you'll obtain written consent from SICA always, and if you're an auditor, then you need to get written consent from IRBA if you want to delegate your responsibility to sign audit reports. With regard to recruiting, the code tells us that we must employ recruitment policies that are fair and equitable. And responsibilities to another colleague means that we should never be harming or talking badly about someone else of the same profession. If we were to boil this down to simple rules, it means we act fairly with other people of the same profession, we don't make large claims, and we never compare services of different people in the same profession. We also ensure that we don't create conflicts of interest. So now let's look at the threats that may be posed towards fundamental principles. I have made an acronym to help you remember them. This acronym is called FAIRS. The first is the familiarity threat. Familiarity threat is characterized by a close relationship. So when you're looking at your scenario, when you're looking at your tests and exams, you need to look out for a close relationship between a chartered accountant and someone else. So what does this close relationship do? This close relationship creates sympathy in the heart of the chartered accountant, meaning that they are not able then to exercise their professional judgment and professional skepticism in an uninfluenced way. What are some examples? Well, if you have a close family member or wife, friends that are working at your audit client, if you meet socially and interact socially with members of your audit client, if you receive gifts or if you receive a large amount of fees from a given client, that can all create a close and unnatural relationship that is no more business but now can lead to sympathetic thoughts in the heart of the chartered accountant. Next is advocacy threat. Now, many students struggle with advocacy threat. Why? Because they don't understand that advocacy threat is all about an idea. If a chartered accountant has an idea that they believe in, then they are opening themselves to advocacy threat. Because advocacy threat is about a chartered accountant being blinded by their promotion of a specific idea or belief. This means that they're unable to be objective and unbiased. Some examples of that would be if we want to offer other services. If we, for example, offer tax services to our client, we will then have a particular idea about how the tax needs to be structured. As a result, we are no more objective when it comes to reviewing and auditing the tax. Other ideas are policies or procedures that may be at our client that we may have been involved in creating or promoting. When it comes to analyzing them, we may not be objective. So to summarize, in your scenarios, the tests and exams, when we're looking out for advocacy threat, we need to look for a chartered accountant that has a belief or a specific idea that they want to promote. So now let's move on to the IR in FAIRS. The I stands for intimidation. Intimidation threats are when a chartered accountant is deterred or prevented from acting in a normal way due to a specific threat. Now notice that the code is very clear that the threat does not actually need to exist. It can be perceived or can be thought to exist. If a chartered accountant is prevented from acting in a specific way, there is likely an intimidation threat. What are some examples? Well, if you were taught by a particular person in your serving of articles, you may have a lot of respect for that person. And as a result, you may not want to contradict that person in later years. This is an example of, yes, familiarity, but also intimidation. You are intimidated by the knowledge and the experience of that person, and so you don't act in a normal way. The R is for self-review threat. Self-review threat is when a chartered accountant has offered some sort of service previously, and then he is required to review or evaluate the service that he is given. So he's basically marking his own test. In the example of a student, it will be like a student writing a test and then being allowed to mark their own test. They are never going to be objective, and the marks that come out of such an exercise will be meaningless. When can this happen? Well, if a chartered accountant either accepts employment at an audit client, or if they were previously at an audit client and now becomes a member of the audit team. This can result. If there's offering of different services to the same client, for example, tax services as well as audit services, you may be required to now audit something that you created. Let's move on to S. And S has its own slide because it is actually a major risk. This is one of the threats that come up most often. But I must caution students not to be trigger happy when they want to write self-interest threat, because if they write self-interest threat and in fact it's not a self-interest threat, the marker automatically knows that they have no idea what they're talking about. So be very careful when you write down self-interest threat. Ask yourself, is it really a self-interest threat? What is a self-interest threat? Well, it is when either the chartered accountant or someone close to the chartered accountant is going to receive a financial interest or some other interest as a result of the chartered accountant's behavior or action. As a result, the chartered accountant will not be able to exercise their professional judgment and professional skepticism in a way that is free from influence. Let's look at some examples of when this can happen. Well, when you are given fees that are contingent on some outcome happening. For example, if you are only going to get a bonus if your company made revenue of a particular amount, you would be incentivized to misstate the revenue. If you as a if you are going to receive gifts of some sort or interests of some sort, if you offer other services to the same client, you then have an interest in that client continuing to operate. So what do we need to look for in our tests and exam scenarios? We need to look for some movement of benefit, particularly towards the chartered accountant or someone close to the chartered accountant. When we talk about close family or friend relationships, we're going to dig deeper into that in video number 3. So now that we've dealt with the 5 fundamental principles and the 5 threats, let's look at how a chartered accountant is meant to evaluate the threats to fundamental principles. The first thing they need to do is understand different factors that may weigh in on their decision. For example, what does King 4 say about this specific threat or the action that needs to happen? What did they learn at university about how they need to react to such a threat? What would be considered to be unethical behavior? And what do the professional bodies such as SICA and IRBA require of them? Next, they want to understand how to reduce the threat to an acceptable level. So how to get it to a level where the threat is now insignificant. This may be done by application of a safeguard. Professional skepticism is about a chartered accountant not taking the information that they receive at face value. Instead, they need to interrogate the information to ensure that what they are given is accurate. And they must always ensure that all their actions are done with an air of independence and objectivity, ensuring that they look out for relationships and situations that may cast doubt on their independence, both of mind and appearance. Let's look at some examples. If an employer gives an employee a loan, what types of threats might it create? Well, it will obviously create a self-interest threat. It may also create an intimidation threat because now the employer has some leverage over you. What fundamental principles will those threats affect? Well, it can affect integrity, objectivity, as well as professional behavior. It is unlikely to affect confidentiality, and it may to some extent affect due care and competence. However, not by a lot. Let's look at another example. You are preparing a valuation for your employer, and this valuation will be used to determine what your employer pays for a given investment. Well, you may want your employer to save money, and so you may amend the valuation to reflect a lower value. This is a familiarity threat because you are sympathizing with your employer. It may also extend out into self-interest. What sort of fundamental principles will it affect? Well, it will affect objectivity and integrity, including due care. What happens if you were involved in the negotiation of the purchase of a new company? Then you are required to decide on the IFRS treatment. Well, it may result in a self-review threat because you're going to be reviewing the work that you had done in the negotiation. It may also create a self-interest threat because you will record it in such a way that makes you, as the negotiator, look good. And notice also that there is an advocacy threat here. You may have a particular idea about what you expected to come out of the negotiation, and this may affect the way you account for it using IFRS 3. I hope all of you all got that advocacy threat. So what fundamental principles does this affect? Well, it will affect your objectivity and integrity, your professional behavior, and due care and competence. So let's briefly look at safeguards, and we're just going to do an overview of safeguards and then we're going to end today's video. So firstly, we want to apply safeguards to threats in order to eliminate or reduce the threat to an acceptable level. We want to make sure that they are insignificant. Once a threat is insignificant, then a safeguard is not required. So safeguards are only applied to significant or dangerous threats. How do we determine if a threat is significant? We need to apply our professional judgment and our skepticism when we are analyzing the threat. Remember the third party test. A reasonably informed third party must come to the same conclusion that we have come to. What sort of things do we need to think about when analyzing threats? Well, we need to think about our professional judgment as well as what is best for the public. Broadly speaking, there are two types of safeguards. The first are safeguards that are created by the profession or legislation. For example, in the Companies Act in Section 22, we are told that companies should not be reckless trading. If they are reckless trading, they must immediately stop trading. This is an example of a safeguard that is created by law. Then we have safeguards that are created by the environment that we work at. For example, you come to university, and at university, students write tests and exams, and they have to be marked by the lecturer and not the student. This is a control to ensure that the marks that are captured are accurate. This is a safeguard that has been created by the work environment. Thank you for listening in to part 1 of professional conduct. Join me next time in part 2, where we're going to be looking at the next two parts in the Code of Professional Conduct, particularly chartered accountants in business as well as chartered accountants in public practice. This is one of the more important sections, so I encourage you to tune in for video 2. Bye bye.